To the stream, everybody. It's rate cut day. We got about 45 minutes before this thing kicks off and goes live with the FOMC press conference. But until we get there, we're going to talk a little bit about the past, historically, where we're at today, what the treasuries are doing, what the markets are doing. So without any further ado, let's pull up CNBC, which I'm going to have streaming on in the background the entire time, just to give us a little bit of color as to what the markets are doing at any given moment in time. If you have not subscribed, now is your time to click the subscribe button. The little link will stay here just to my right the entire time. So if you have been watching the podcast like you should, you know that this meeting is going to be impactful because the markets have already effectively priced in a rate cut. And if we do as we are supposed to be doing, that means that the market will wildly anticipate this and the market should not react. But the real fun of this entire conference will be in the FOMC commentary minutes of the meeting. So let's listen to what the exchange got going on right now before we get into it. What's up, Regil? Let me know how the audio sounds.
Mortgage rates dropped yesterday to their lowest level in 3 years at 6.13%.
I'm going to pull it down just a little bit.
And today, pre-Fed announcement, they're just slightly higher at 6.15%, according to Mortgage News Daily. Now, if the Fed does do the expected quarter-point cut, some experts predict longer-term bonds might sell off, increasing interest rates. It depends.
I believe that to be a very big probability myself, personally.
But that's what happened last year after that first cut. Now, an initial drop in rates last week caused a massive run on refis, with those applications jumping 58% compared with the previous week. Refinance demand was 70% higher than the same week 1 year ago. All that, according to the Mortgage Bankers Association. Now, the refinance share of mortgage activity increased to nearly 60% of total applications. And the average loan size on refis reached its highest level in the 35 years.
So we're going to talk a lot about mortgage rates today. I think a lot of people who are watching this are really concerned about what this is going to do for the mortgage market. And I got to tell you, I think that's probably reasonable. The last time we saw rate cuts, as she noted, you actually saw the mortgage rate creep up. The 10-year treasury, which we use as the best proxy for mortgage rates, went up immediately afterward. That's because the rate cut was priced in and the market was preparing itself for it. What's up, Isabel? Hey-oh. So one of the things I thought was really interesting coming into this was the treasury movement from the week. We saw a lot of things happening that was what I would call curious leading up to this. You got the Chicago Mercantile Exchange. Yo, what up, Logan? What up? Like to see people coming in. Makes me feel like I'm not actually talking to myself the entire time. Let's go to Chicago Mercantile Exchange, CME Group. We like to check this pretty regularly on the show. For those of you who know the show well, you guys have listened to and heard this, but I'm going to display that here on the screen for you momentarily. So again, for those of you who just joined, we're going to watch CNBC in the background until the actual conference starts, and then I'll switch the stream over to the actual official channel for the Fed, which is also on YouTube if you guys are interested in watching directly there. This is the Chicago Mercantile Exchange probability of a rate cut. What's really interesting is leading into this meeting, you had a 96% probability of a 25 basis point rate cut, which is really what this piece here was anyway. It's now down to 93%, but the 50 basis point rate cut has actually crept up a little bit, which is funny to me because it's kind of like your Vegas betting odds, everybody getting excited right before the actual game starts. But in this case, I think it's pretty much a guarantee of 25 basis points like we talked about on the show. What's really curious is going to be the commentary from Jerome Powell, the summary of economic projections, and some of the dot plot stuff that's going to come out from the FOMC, which is going to really tell the market whether they're dovish or whether they're bullish. And for those of you who don't know the difference, dovish, they're really not sure what's going to happen. Bullish, they're pretty confident this is the right path. What up, Big Vic? So they're going to try to find a way to, I guess, navigate the rhetoric in such a meaningful way. And again, for those of you who do listen to the show on a regular basis, you know that it's been largely my opinion and Saeed's. I believe that the FOMC speaks too much. This is the most communicative Fed we've had ever. And as a result of that, some of these things that we're seeing now, press conference-wise, are a little unprecedented. We've never seen this type of hype and hysteria building into it. But, again, these things happen. Saeed, I believe you're also a moderator if you're there. I think I made you one a long, long time ago, so you might be able to have some control. Regil, if you're not, I will have to set that up for you later tonight. I tried to find it earlier, but I'm going to say this right now. YouTube live streaming is not exactly what I would call simple. But, hey, I'm different. All right, let's listen to, UBS home builder analyst. Let me guess. He's going to be super excited about what's going to come for the home building
with the outcome
markets.
Would be longer term for the economy, but that would be good for housing in our view. Lower rates, again, stimulate demand.
Yeah.
They
leg
do.
to the mandate that people have more or less said, well, it's kind of redundant, or it's just going to take care of itself. But who knows what that means down the road for balance sheet usage and stuff by the Fed. I guess the other question is affordability, which is obviously,
It's
pretty
the only question,
Is there
man.
any hope there?
If rates come down, that certainly helps.
Yeah.
And what's been really interesting is the builders have been very effective in buying down mortgage rates. So if you went to a public builder, you weren't paying the 6% today. You're paying 5. You're paying maybe just under 5. To the extent that we can get lower rates, the key here will be the builders will not need to buy down, and that's very accretive to margin. Or they won't have to buy down as much.
That makes the builders make more money. So what he basically just said was, the builders will be able to sell the homes for a little bit less because they won't be buying down the interest rate on behalf of the buyers. For the first time ever in history that I'm aware of, buying a new home now is cheaper on average across the country than buying an existing already built home. Think that through. Brand new home, cheaper than buying a pre-existing older home in markets. And there's a lot of reasons why that is the case. But he is part of the problem, as far as I'm concerned. Demand without affordability is not demand. We say that a lot on the show. I get a lot of hate for that on X and a lot of other places. But what I'll tell you is this. If mortgage rates do drop meaningfully, and they already did drop leading into this, you're in the 6% range. I think I had an article on that I'm going to share on the podcast later tonight. But here we go. The average contract interest rate for 30-year fixed mortgage rates with conforming loan balances at 806,500 or less decreased from 6.39% from 6.39% from 6.49%. So about a 10 basis point or 0.10% difference between what actually they were priced at before and leading into this meeting. That is, in effect, the Treasury saying, hey, you know what? This is where we're going to wind up on interest rates. We're going to have a 25 basis point cut. Now, if they cut 50 basis points, you can expect that to drop. If they cut exactly at that number, 25 basis points, I don't think you see anything besides probably interest rates creeping up over time. You're not going to see this big windfall of opportunity like he's suggesting is going to happen. As a matter of fact, this might actually be a non-event. All of the real events here are going to come from the commentary from the Fed. What up, Danny? The crazy Johnson tribe. Where do you project SPY to end after decision and Powell? Assuming the decision is in line with thoughts, I think the market's going to be kind of relatively tepid. We're already at or near all-time highs, so I don't expect there to be much change. Frankly, I don't think you're going to see a huge sell-off unless he comes out and he's just super dovish. If there's not a rate cut, for example, that could move the market. But for a large part, I don't think you're going to see a lot of action today. I think a lot of the action will come in the analysis of the commentary, really tomorrow if you see any type of movement whatsoever. But nothing really significant today. Excited for the live podcast, Danny. I am too. Saeed and I have talked about doing this for probably 4, maybe 5 years. But being with companies and having a job, it was really hard to do this during normalized hours. And now that I am wildly unemployed, or I like to call it fun retirement or retire fun, I don't know, who knows. We can do this all the time. And so I actually originally built this so for Saeed, Rajil, and I to all be on screen at the same time. So I'm technically taking Rajil's spot. And then I can switch over to the other camera in the other room, and you can see Saeed and I normally the way you would on a podcast, but you can see it as we react to the market like we're going to do here. So, yeah, no problem, man. And again, I'm here to answer questions. We got about, call it 30 minutes before the fun stuff kicks off, and I'm going to try my best not to speak over Mr. Secretary as his comments come in, but you will probably find me being snotty and giving attitude during the stream because that's what I'm here for. Rosie, what up? I don't even watch YouTube, but I'm here to support y'all. Hey, that's love. That's love. And we appreciate it. I am also responding to the comments and reading them in real time as I go back and forth. Let's check X for a little bit and see what X is saying. I think for the most part, we're seeing a little bit of breaking news. This ought to be cute.
Waiting for has finally arrived. It is Federal Reserve decision day. Markets, they could be coiled to respond. Welcome to Power Lunch, everybody. I am Brian. Kelly is off, and you are just under 5 minutes away from the Fed's latest decision on interest rates. Wall Street anticipating the Fed will make its first cut of the year, 0.25% expected, but there is way more drama than just an interest rate cut that pretty much everybody and their mother and their mother's mother expects. We're going to get you the full storyline in moments. And with those moments to go, here's how things look. Stocks actually mostly on the rise. The Dow is up 0.5%. People don't really care about the Dow. Small caps actually up about 0.6%. They're seen as more of a beneficiary of future rate cuts. So maybe small caps are telling us something. The NASDAQ down about 0.4%.
Nothing meaningful here.
The longer in, as they say, the yield not moving. Why would it? They want to hear what Jay Powell has to say.
This will move in response to his commentary, not in response to the cut, assuming it's 25 basis points.
And then, of course, gold, Bitcoin, the U.S. dollar, the currency complex. Gold down just a bit, but gold at a record high as well. Bitcoin on the move, too. Bitcoin
down 0.06, 0.07%. That's not down. That's just normal fluidity throughout the day.
Enough talk. Let's get right now to our all-star panel here.
All-star panel.
We've got David Kelly, J.P. Morgan Asset Management, Francis Donald, RBC Capital Markets, and Jim Caron of Morgan Stanley Investment Management. All right. Bank of Canada is down. So here, Federal Reserve U.S.
I'd like to point out that none of these people are dressed like I am, appropriate for the occasion, with the new anti-guru Club merch on.
That labor market is looking worse, but I want to hear how they characterize
the best. Go to the store, pick it up.
Still too strong, likely to reaccelerate.
Could the dovish stance for a rate cut today be due in large part to the tariffs?
So this is a central bank that's
doesn't sound like a cutting environment to me.
Doesn't sound like one. So I want to hear how Chair Powell is going to navigate what is still an inflation problem and likely to become more of an inflation problem while he's still cutting.
Okay, David Kelly, do we get a cut today?
Yeah, we do. We get 25 basis points.
David Kelly, stud, by the way.
Cut today, because
shouldn't cut.
Will cut. The reason we shouldn't cut is because the Fed is further away from its inflation objective than its unemployment objective, and it believes it's going to be that way at the end of the year. I don't think we're on the brink of a recession here. It's a slow economy. But the problem is there's politics here, and there's also messaging. And I think
lots of politics
what we're looking at is how many people dissent. Do we get three? I mean, is it a prerequisite in order to be in the game for Fed chair that you have to dissent 50 basis points a day? Is that part of, is that just table stakes? So that's one question. And then a second question is, does Jay Powell have to defend cutting rates today by saying the economy is looking really, really weak? Because that messaging actually hurts the economy.
Yeah, it does. You can't say that.
Whatever we get today, a rate cut does not help the economy grow faster at this point.
Jim?
I'd agree with that, yeah.
So I think they cut 25 basis points, but I don't think it's just about the economy. I also think it's about the balance sheet, and I also think it's about liquidity. So what we've started to see is that repo rates have started to rise, bank reserves are falling. As the Fed has kept interest rate policy unchanged and the balance sheet has started to shrink, that has created some liquidity tensions in the markets. So part of the reason why I think the Fed should cut rates this time around is to address those liquidity issues.
Yeah, I disagree with that.
Rates rising and bank reserves.
So I'm going to talk about a couple things here that I think are important. And Recuser, very, very astute comment. Unemployment creeping up a 25 basis point cut or even 50 basis point cut won't keep it from climbing. That is factually and historically correct. That is a trend you've seen in every recessionary economy. As a matter of fact, unemployment typically peaks post the end of recessionary economies. Not saying that we're in one, but as a proxy for how bad the economies were in those instances and where we're going to. In most cases, yes, unemployment rising is a normalized cadence. The one thing that I disagree with David here, and I think is meaningful, is that while there is not clear and concise data which says that a rate cut is absolutely necessary, there's a bit of debate in politics in here for sure. The one thing I can tell you is that you cannot stop the economy on a dime. So it's got this momentum built into it. So if you don't start rate cuts at a certain point and then build up to additional rate cuts if you need to, you won't be able to stop the cadence and trajectory of where the economy is going. So I think that he's wrong in that a rate cut starting now is necessary to start the kind of tapering back in the worst case event scenario that things do become recessionary and things get out of line. The argument that the Fed has always had is that they're very data dependent and that they're looking at the trending of these analytics. And as a response to that, I would say, okay, well, everything is now trending the way it's supposed to go. The last PPI and CPI rate, very different. Breaking news all over the news. Here we go.
by a quarter point as expected to a new range of 4 to 4.25%.
There you go.
New Fed governor and former CEO, or current CEA chair, Stephen Myron, dissenting in favor of 50 basis point cut. The median Fed official looking for 2 more rate cuts this year, but just barely. I'll get you details on that in a second.
There it is.
The statement importantly says the balance of risks have shifted. Downside risk to employment has risen. Job gains have slowed. Unemployment has edged up. And economic activity has moderated. At the same time, the statement does note that inflation has moved up and remains somewhat elevated, but clearly the Fed favoring the concern about employment here over the concern about inflation. It says uncertainty remains elevated as well. On the rate outlook and the so-called dot plot, some really interesting movements here. As I said, the median Fed official forecasting 2 more rate cuts this year, but just barely. There was massive disagreements among officials on the rate outlook for 2025. Very unusual with just 2 more meetings remaining. Let me give you the data here. One official doesn't want to cut at all. There was no other dissent in favor of not cutting today, but one wrote down the current rate or the previous rate as their dot. 6 want no more cuts after this one.
Wow.
9 want 2 more cuts. And one official, I guess we can guess who it is, wants 5 more quarter point cuts this year, or 125 basis points, to bring in the Fed funds rate down below the median neutral rate. So there's a big time dove on the committee. I think the committee at the headquarters here will have some fun figuring out who exactly that is.
Put
The
Neil on
median wants
timeout.
1 cut in
Yes,
27
you're not wrong.
and 1 in 28. So I'll give you the numbers now. 3.6 is the median forecast for this year on the funds rate.
Okay.
Down from the current of 4.125. So that's 2 cuts. 3.4 for 27 and 3.1 for 2028. A little bit more on the economic outlook. Core inflation unchanged.
Look at the 10-year. 10-year is flat. 10-year is 4.018, 4.02. So slightly down, but nothing meaningful. So no big move in mortgage rates.
Below the 3% neutral rate in 2026. That's up from 2 in September. So they're looking for a little bit of stimulus down the road next year in the funds rate. 6 want to do so by 2027. Brian, I'll send it back to you. And the smart people around the table there to make sense of all this.
Well, that's a pretty smart person down there in D.C. too, Steve. Should we assume that it is new Fed member Stephen Myron that is calling for the 5 quarter point cuts over the next couple
There
of
it
meetings?
is. There's the call out.
This was my speculation leading into this, and that's what I think it is, Mike.
I totally agree. So
Stephen Myron out there basically doing the president's bidding,
Yeah.
calling for very sharp rate cuts immediately. I guess that would.
And this is why you don't want the political twist on Fed policy, right? You have somebody who the president named coming in now swaying the commentary in the minutes in the meeting saying that he wants 9 more cuts in a year. That's kind of ridiculous. And everybody kind of knows it's an inside job. I mean, listen to the commentary there.
Kind of like this Canadian reference, the yellow knife in the Northwest Territories, kind of way up and out there. Steve, stick around.
There was a joke, Brian. There was a joke among one of the Fed reporters here that we were going to have to get a legal pad to get the dot plot together. It'd have to be a longer piece of paper.
I love
Oh,
that. You go
wider
from the
numbers.
11 and
That's
half
a terrible
inches to the
joke,
full
but we'll
14.
work on it.
I mean, I'm old enough to get that reference.
Yeah,
Steve Leishman,
Cash.
thank you very much. Let's go back now to our esteemed panel. Steve is still there. We still got to look through.
Look how serious David always looks, by the way. David, JP Morgan guy, never smiles. Look at him.
Francis, your immediate
He looks like he's pooping.
on this decision.
Well, hearing about that dot plot, maybe I'll come in defense of the
She
dot
looks
plot.
happy.
There'll be a lot of comments about this being very political in nature, but this wide dispersion in views on this
The
Fed.
Fed, way. Thought the Fed wasn't political.
Treasuries are dipping a little
Well,
bit,
it's
4.015,
independent. Let me just say,
4.016.
because there's going to be
Tiny,
questions
tiny.
about this.
Dow's
there
up.
is a lot of confusion
Again,
about the
a
state
little
of the
bit.
U.S.
These are not
economy
meaningful
now.
moves in any market.
It's not clear how much should the labor market truly be weakening. When will tariffs come through? And some of this dispersion we might be seeing in dot plots, some of it, not all of it, may very well be a reflection of the confusion of this economic moment. So we have to be careful about taking any headlines about the median dot here from what I'm hearing, because we have huge dispersion within Fed members. This is going to call more attention into absolutely who is going to be at the Fed and who is going to be leading the Fed not too many months from now.
I think this is actually really important that there was only one dissent. Because what that tells me is that even
The
though
dissent
Governor
was the
Bowman,
newly
Governor Waller
named
may want the job
guy.
of Fed chair, they're not willing to go against the consensus of the Federal Reserve in order to get that. I think that is a very, very positive statement. So, I think, Jay Powell is Mr. Consensus. He wants to get consensus. Clearly, he talked to everybody before this meeting.
Come on, smile, baby.
And to me, the
smile.
fact that they aren't,
Give me a
they're
wink.
not going to fall over themselves to say 50
Let me know
basis
you're
points
real,
down,
brother.
even if they want more Fed easing, I think that's a very positive sign because it says the Federal Reserve as an institution regards its independence as tremendously important, and they're not going to fall over themselves to do what the administration wants right now. And I think that's a very positive sign.
But our job, Jim, here is to look ahead.
Okay, but that's also a bit, okay, so let's walk that through. He said that politics aren't going to change the narrative, right? I'm going to use the control panel here to delete these. So that's not necessarily true. You already have the president who's come on board, who's put somebody new in place, who's clearly meaningfully shifted the dot plot, and he's got a lot more rate cuts that he's suggesting. And now he's the one who called for the 50 basis point. You saw that pop up here in the red bar on the screen. So you wind up in a situation where politics are having a meaningful impact here, although it's not supposed to. And again, like we all know, Jerome Powell's tenure is going to come up here at some point in time. And while he'll still be a voting FOMC member, he's going to lose that chair seat, and that's going to become a very political conversation too. So to suggest that politics, it's not going to have a big impact. If you have a new Fed chair, which is politically driven, and at least one member who's politically driven, and yes, there's 11 voting members, and there's lots of reasons why the math works in the favor of the FOMC, you start to chip away at the neutrality of the organization by putting in politics in place. So completely inaccurate. David is a politician. He works for JP Morgan Chase, little guy you might have heard of. Jamie Dimon is his boss's boss. And you know what? Maybe that's why he's not smiling. But clearly I disagree with the non-political interference.
Productivity is likely to start to move higher into 2026. It's already doing so in 2025. That means markets can support a higher
gorgeous,
multiple,
my wife's on.
And it's bullish for the equity markets in that sense because higher productivity means growth with relatively lower.
Okay, speaking of the equity markets, a couple things I want to quickly hit and then get reaction to it. The macro, the bigger markets, not moving a whole lot. S&P 500.
Which we called. We said that we're going to do that.
Who cares? What is moving is the small caps, the SML Small Cap 600 Index.
Yeah.
We don't talk about it a lot. It's up 2%. Here's why I'm talking about it, Francis, because small cap stocks, domestic American companies, almost entirely all their revenue is in the United States. Mm-hmm. Those stocks tend to move at the later end of a rate cut cycle. So I want you to comment on that move as well. And here's the other news.
It's irrelevant.
The 10-year yield didn't move at all.
Because the 10-year priced it in.
Exactly 4%.
I told you. Why am I not on this show?
100
Seriously.
Of 1%.
Yeah, because the market priced it in. Mortgage rates have already dropped.
You're thinking,
you're not going to see more mortgage relief here.
Because mortgage rates are going to come down. The bond market is saying you might be out of luck.
Yeah.
Well, you have two issues in play here. One is that this market already priced in pretty significant easing from this Federal Reserve. So today was just meeting the expectations already in the market. You're going to have to out-ease those 5 cuts that were already put in if you want to see additional support coming through.
Which is also precisely why after the last rate cut, mortgage rates went up, not down. And this is why I keep trying to tell people, you'll see if you're hearing it on the news, it's already typically too late when it comes to the stock market, treasury market, bond market. And this is a great use case example of it. You're not seeing the treasuries rise. Yeah, she does get it. Big brain. She's a smart one, this one. And she smiles. So Brian could learn a lot from her.
On CNBC earlier today, said something very, very smart. Says a lot of smart things, David. But one of the things he said today was that we've got to remember the Federal Reserve, this rate call that we're talking about right now, the reason that we dragged you all to New Jersey, this is the overnight lending rate. It's basically tomorrow. What our audience mostly, what JP Morgan's client base mostly cares about is what happens down the road. And the longer-term bond market isn't moving.
No, but this is actually good news because our great fear,
good news,
all of us,
David's still not
if
smiling.
the Fed becomes political, they cut short rates too much, and everybody says, you know what, we're off to the races in terms of government debt, we're off to the races in terms of inflation. That would cause the long-term rates to go up.
All right, Grumpy Pants over there be doing his thing. But look, you're starting to see the 10-year Treasury come down a little bit, so maybe you will see a little bit of a rate drop. So I don't know. Maybe we'll see where the market goes. Keep in mind, we started at 4.018, so we're about 0.02% off.
Is the fact that we only got one dissent to this decision makes me more confident that all this talk about not reappointing the Fed president.
Isabel, what's up?
The Fed as an institution has a lot of strength if it holds together, and I think it will maintain its independence and, you know, and try to be apolitical. It's not a Republican Fed, it's not a Democratic Fed.
Oh, there's political interference. David's just a politician because he works for the largest bank in the world, and J.P. Morgan Chase, and let's be honest, Jamie Dimon is about as much of a bank politician as you can get. But let's skip that. Logan, you are absolutely correct, and that is not cynical. The bigger problem here is that demand without affordability is not demand. If the mortgage rates come down just a little bit, and we saw, again, a 10 basis point drop in mortgage rates, I quoted at the top of the show there, you're not going to see a meaningful change in mortgage rates. It's only going to make demand go up because people are going to jump into the market a little bit. But again, it doesn't affect affordability and home prices. You still need a solution to home affordability. I read an interesting article last night about the consumer spending segment, and I sent it over to the boys this morning. Let me read you a quote from it because I thought it was really interesting. So according to where did I go here? Here we go. The top 10% of income earners, this is according to Charlie Bilello via X. The top 10% of income earners in the U.S. now account for nearly half of all consumer spending, a record high. So that's telling me that you're seeing a pretty wide disparity of what you're actually getting versus you know, who's spending and why. So I'm going to shrink this here a little bit and minimize it. This is Charlie's page here. This is the graph that he posted with it. So high-income Americans are behind roughly half of all U.S. consumer spending, up from about a third in the early 90s. So that's going to artificially prop up the image of consumer spending, making the economy look like it's a lot stronger than it is because there's a disproportionate amount of wealth. And this is the wealth gap argument that you've heard so much throughout time, where if you continue to push people out of home ownership, the single largest source of wealth building for most Americans is the equity appreciation in their home over time. And if less Americans can buy homes at a younger age, in fact, some of them don't buy at all, then they're losing the number one add to their net worth, which creates a wider wealth disparity gap. You have the uber wealthy who can afford homes, and you have everybody else. And right now, you're at the widest gap between rental prices and home ownership prices. It's more expensive now than ever than it is versus renting in American history. So this is only causing a problem which is going to manifest later on. So we think that, oh, you know, hey, some of these problems are temporary. They're not temporary. These will continue to be problems. If people can't afford to buy homes in a meaningful way, and they can't afford to get that equity building over time, they're losing the value of the appreciation in home values. You need to have some type of mechanism to correct for this. Here we go back to Steve.
List, Brian, for things that we're uncertain about. We haven't talked about the impact of immigration on the job market. The job market may be perfectly healthy given the immigration levels that we have, even though the Fed is looking at downside risks here. I think, by the way, that's something that stayed the hand of some Fed officials that are saying maybe we shouldn't be cutting more than one other time this year because of the idea that we may be at a break-even rate of 20, 30, 40,000.
Thanks for stopping by, brother.
The right number, given what's happening on the immigration side. AI would add to immigration, would add to tariffs, and you can see a line in the statement that says the economic outlook is uncertain or highly uncertain. I want to pick up on something David said, which I think is really important. The idea that Bowman and Waller did not vote with Myron on a dissent for 50, I think is very important. It does underscore that at least those two officials are more interested in the institution, in the independence, than they are in getting the job. I think that's a big thing, because what we've seen in the past, Brian, is you have a Fed official who dissents, and they make their dissent known, and then they come back into voting with the consensus. We've seen that a lot. One other thing that was not mentioned around the table, which is we're now in a position for the
Sam, I want to get to that. Give me a second.
Talking here. If the economy weakens further, the Fed is probably well positioned here. The market is probably well priced. If it doesn't weaken further, then
Steve Leisman stud. So Sam, your point is actually a very valid one, and this is I am a real estate broker. I'm a realtor. I've been in the real estate business. I own property. I sound like I'm a big cynic of the real estate industry and subject matter experts in that space, and I'm not. But there are a pretty wide gap there is a pretty wide gap in logic when it comes to this. And Sam, your point is exactly the problem. Just ran into a home builder at Smoothie King. He believes the rate cuts will push mortgage rates back down and home buyers will be back to the races. Direct quote. He also said it has to get better. No, it doesn't. We are at an all-time unaffordable home price. That's a wild disconnect to the market. everything we've seen from the last rate cut shows that rates rise afterward, and you're seeing the behavioral pattern going into it, where you saw mortgage rates come down slightly running into it. So it's a pretty wide disconnect, but that is a lot of the quote, and I'm using the bunny ears here, real estate professional mindset. And this is what frustrates me. There's a lot of realtors and brokers and subject matter experts who clearly get this, but that is not true. And I had a conversation with a family member recently who said something very similar. Oh my God, it's going to be a mortgage refinance boom. No, that is not what you want. And let's not forget that a lot of people who refinanced in the last 14 years, that period, 14 years of artificial interest rate deflation, they have mortgage rates sub 4%. Today's mortgage rate, even with the drop, is just over 6%. So it still isn't economically viable for them to refinance. For some people who have maybe a 7% or 6.5% rate, maybe if you have a 7.5% rate, that might make sense for you when you add in cost to refinance. But for the most part, this may just serve to drive up home values a little bit more incrementally until whatever the hell happens to get home values back in line. And I don't know what that is. No one really knows what that is yet.
All right, so here's what I'm going to tell you guys. If you look at the markets right now on your screen, what you are seeing is a general positivity in the Dow so far.
Agreed.
But an S&P and NASDAQ that are now below where they were before the Fed rate cut announcement came out. And just to kind of give you an idea of a benchmark, if you will, if you look at an intraday chart of the S&P 500, just before the decision came out, we were at roughly 6,600. Right now, the current price, as you can see, is 65.87, so 13 points below where we were before the numbers came out. It got as high as 66.24 in the 2 or 3 minutes right after the announcement. So it's gone up 24 points from there and given up all those 24 points.
I know that sounds sensational and cool and like, oh my God, like he's pointing out some really important, relevant details. But to be honest with you, none of that really means anything. The movements you've seen in the market in the S&P and the NASDAQ and the Dow and all that, there have not been meaningful moves. The movement you're probably going to see today is like stuff like this, incremental stuff in the banking sector. But even then, people aren't really going to say, okay, this is going to widen things out. For banks, it might be a bit of a boon in that it'll help them out, in that banks make money on the spread between the difference what they charge on loans and what they give you on deposit rates. A lot of banks will be able to cut their deposit rates on some of their larger deposit relationships and even some of your retail deposit relationships by 25 basis points. So if you want to see if banks are looking to make more money, that's how you tell. If your deposit rate goes down in your savings account by about 25 basis points or maybe even 10 basis points, then you'll see that the banks are getting ready to price in more profitability because that net interest margin, the spread on the difference what they're getting on loans and what they're paying you on your deposit rates is getting wider because they're going to ignore the benefit of this rate cut to some of those accounts. And as you might remember, in the last couple of years, banks got really highly competitive for deposit accounts. And what did? They started pricing those high-yield savings accounts higher and higher and higher. They're going to look to correct that in the market in the coming months and years.
Santelli, not a huge move in the 10-year today, but I would imagine you're going to tell us that the move we've seen the last couple of weeks has been the anticipation of what we got today.
No shit, Sherlock. Yeah, I cussed on this, by the way.
Let's get
Put an
to that.
explicit
Let's
rating
start
somewhere over
first
here
with the
next time.
two-year. Two-year was around 353, up 3
Beverage
basis
time.
points on the session when the announcement hit. You could see it traded down on the intraday chart to 346. The current low yield close for the year was on the 8th of September at a 348.
Hey, Saeed, I'm going to drink yours for you, okay?
We are technically guns hot for a new high yield close, and that goes back to September of 2022. The 10-year that was just referenced, the last 6 or 7 sessions, it's been like compressing right around that 401.
So this is actually interesting. We are seeing a little bit of movement in the 10-year down today, which is not what I would expect. That doesn't necessarily mean that mortgage rates are going to drop, pari passu with it, but it's interesting. I am selfish, Saeed, but I love you.
So basically 2s and 10s each moved about 5 basis.
Yoshio, what up, guy?
399. We traded down to 398. But the reason 10 years are so important is because if we start to close the day or a week especially is a high priority technical signal under 4%, that will be very significant.
Yeah.
Right now, we're still seeing basically white noise, not a convincing performance under 4%. We are at the lowest yield close of the year at 4% from the 4th of April. And finally, the dollar index is the big mover on the session, and nobody's talked about it. The dollar
I don't think it's meaningful. That's why.
is down about a third to a quarter of a cent since the announcement. It's on pace for the lowest close going back to February of 22. And all things considered, I think you want to really pay attention to the 2s-10s spread. It initially steepened. Now it's back to 51. Without steepening, maybe we could trade a bit.
This show is not brought to you by
although
C4
I bet
because they won't
against
return our messages and sponsor
That dollar
us.
index is a big deal. Keeps going down. To your point, maybe not enough talk about it. Rick Santelli, thank you very much. All right, now let's get a trader's take. Joining us now, Steve Grasso, contributor, CEO of Grasso Global, somebody I will see on Fast Money tonight.
That is correct. Looking forward to it.
We're both going to schlep in New York after this show. It didn't look like the Federal Reserve hit the panic button.
They did, and you wanted to check a box, and you know.
I would disagree with that. They're not checking a box. What the Federal Reserve did was they're trying to slow the car down a little bit, the car being the economy here, and try to get the general movement of the data that they're tracking. Because remember, they are data dependent. They're trying to slow the cadence of changes. This way, if they slow them down a little bit, if something does go wildly out of line, inflation creeps up, unemployment creeps up, something happens, they can continue to put the brakes on that movement. Again, it's a momentum game. It's not just a unilateral stopping. So this was the right move. A lot of people who are going to be the anti-politics people are going to say, well, this was influence or they were pressured. And certainly there was a lot of rhetoric in the news trying to pressure them into cutting immediately. But this is also not a massive cut. It was a 25 basis point cut. The Fed has always said they're data dependent. I think this was the right move. I think that this was a smart decision on their part. Now, this does not address the affordability issue. I think what a lot of people think is going to happen is you're going to see like several rate cuts, rates going to go back down to historic lows. That would be a very dumb decision. That would be very bad. And if that happened, that had to be politically influenced, or we have to be in a massive recessionary economy, none of which I think is probable or likely at the moment. So that being said, I think what you're going to see is you're going to see jobs, unemployment continue to rise slowly over time. You might see inflation creep back up, but now the Fed has the ability to put 25 basis points back on or pull it back off, depending on how the market reacts to this. It's a litmus test, and that's important.
Mortgage holders have a rate below 5.5%.
Yeah, there you go.
They're not going to move unless that rate narrows considerably. They still might
That's
pay
right.
more than they are now,
That's right.
but it can't be 3% more.
Correct. And when you think about it, we don't live in houses. We live in mortgages. We own mortgages, not the house. So in 2021, in January 2021, people wound up refinancing their mortgage rates. They got it below 3%. I think you were one of those guys.
Right. And this is what I talked about earlier.
I'm the one who didn't.
That's right.
2.71%, baby.
You need to
for 30 years.
The housing market.
Solid. Even my investment
5.5%
properties are below
unlocks the
5%.
market because we're going in the general right direction. I think that's a big thing for the markets.
So
Yeah,
the move
agreed.
we're seeing, so small caps, the Russell 2000
All right, I don't
guys,
really care about small caps. So here's what I'll say on the mortgage rates. This guy gets it. There's not going to be meaningful numbers. But Nick, to your commentary about unemployment, you're going to see unemployment naturally go up, but there's also been some meaningful changes in the data, which I think people are really confused about. The way we calculate unemployment has changed. You have to actively be looking, for example. There's time constraints. But I also think there's a disconnect, too, on social media has had an influence on humanity and the culture. There's more people now looking for side hustles and other added employment than ever before. And because of that, you're also seeing the numbers be skewed, because it used to be one income households were good enough. Then it was two income households to keep up. And then now it's two income households and a side hustle just to get by for most Americans these days. So that data in and of itself is unreliable. Plus, you have to understand the housing data is lagging indicators of the companies that report in. Said and I covered this, I want to say on episode 300, that only 43% of the companies that used to report in, it used to be 60% report in. So that's a 17% report in drop off. The private ADP payrolls seem to be a better data source, but the way we collect this data for employment, for housing, it's all wrong and outdated. And I think that was the promise of Doge that was supposed to be given to us, but I don't think that's actually what we're seeing here as a result. But we need to find a better way to get data. Mortgage applications is a great real-time version of that. We can see mortgage applications come in real time and report in real time, but properties that are sold, well, you get a property under application, takes about 30 days to close, then that has to get reported through title companies and public filings. So again, wildly delayed. So there's a lot there that I would say is inaccurate. We are approaching 6 minutes out from the actual Fed press conference. If you've been listening this long, thank you. Subscribe to the channel if you haven't subscribed. Follow us on the social media channels. But more importantly, the big part of what we're here for is coming up next. Remember, the rate cut is something we all knew was going to happen. None of this is news to us. This is all pretty standard stuff. The 10-year's back up to 4.015. So I think you've seen a relatively flat day on all the treasuries. Even though it's a little red, it's incrementally down. What we're really here for is what comes next. We're here for the piece of this where we hear the Fed's commentary. This will be divided and diced up and talked about for the next couple of weeks, and it's going to be really important as to how the market reacts to just because the 25 basis point we knew. It's how the Fed articulates how they feel about the data they're looking at and the market that we don't know, and that's what the Fed conference is all about. That's what we're really here for. Hey, Rosie.
They got their quarter point cut, so you're not going to dissent against the thing which you were arguing for at the last time. What do you make of Myron's position? Calling for a cut of 0.5%.
Well,
Myron's politically motivated, so we'll skip that. That was Trump's choice. So, Rosie, to answer your question, I'll give you your best case scenario, worst case scenario, and I haven't really been asked that. So, worst case scenario is that inflation creeps back up in response to the tariffs, unemployment continues to rise, and we see a little bit more volatility in the VIX, largely brought on by what has been bringing stuff on politically the last couple of months. And then you lead into a recessionary economy. One of my favorite economists, Mark Zandi, said there is an uncomfortably high 48% probability that the U.S. economy will suffer a recession in the next 12 months. That's according to Moody's recent unveiled leading economic indicator. They use a new version of this. It's derived using machine learning algorithm, and they have their massive database. It's less than 50% at 48%, but historically the probability has never gotten that high, and a recession has not happened. So he's basically saying all the data and the red flags are warning towards recession. That is my worst case scenario. I am one of the few in this space who really feels that a recession is something we've been in for a prolonged period of time, and this current bubble that we're seeing forming in all these markets is meaningful. Best case scenario is that it doesn't happen, is that the markets can withstand this. AI is really important technology, that the Mag 7 continues to lead the sector, and as that happens, you wind up having a new normal. I don't know how you solve for the home pricing and affordability issues, but certainly that's part of it. Any opinion on how this all affects crypto and BTC in particular? Yes. I have always been a fan of crypto. I sold out of my positions largely because I just didn't have the time to keep up with it, because this data and all that data is a lot. I think as of right now, you've got too many institutional people in the crypto and particularly BTC, Bitcoin space, Ethereum as well. And I think that the blockchain and Web3 is important and meaningful. I think that its best use cases are still in front of it. We haven't seen it in title. We haven't seen it at DMVs. We haven't seen it in receipts in stores. And that's where I think Web3's value really is. And cryptocurrency is no different in that regard. I don't know that it's a true hedge against inflation. I don't know that gold is either, for that matter. I know there's a lot of pundits who believe that. The best way to make money is to the best way to hedge against inflation is to keep investing. That has always been the point historically. I think that is a tried and true and tested methodology, kind of dollar cost average your way through it. I see Bitcoin continuing to rise. I think crypto in general will fall back on the major players, those like Ethereum, those like Bitcoin, who are backed by institutional and money. But I think their brightest days are still ahead of them until such time as something changes and the economy pivots. Whether that's a recessionary economy or not, I don't know. But I'm not what I would call dovish on Bitcoin. I think it's got some meaningful legs underneath it. It's just really expensive to get into at this point. And in the days of like penny stocks, popping on the crypto front, and some of the smaller currencies are gone. Let's jump into the beginning of the web conference.
Balance sheet. Now you see it balloon to $9 trillion. Now we're below $7 trillion. How can they still allow MBS to roll off and still be cutting? So you have that push-pull to me. And that MBS rolling off has the most inflation, if you will, upward price momentum on your mortgage rates. So it seems like there's a push-pull. They're doing counterintuitive things. Where do you come down on that?
Well, it is a push-pull, and indeed it's been a push-pull now going all the way back a year ago. Remember, we got 50 basis points almost exactly a year ago, and another 50 the remainder of 24, and yet the QT program continued. You see something similar at the Bank of England. They're doing QT and cutting.
I don't like how people continue to reference the Bank of England. I think their economy is very different than ours, and I think that's a misguided comparison from my personal opinion.
We may be coming towards the end of that process at the Fed in the coming year or so. But sure, this has been a fact of life in markets now for at least a year.
Yeah, and just a reminder to our viewers, we're looking at the podium. Jerome Powell tends to be exactly on the nose with time. So 2:30:00 Eastern time, he tends to walk out. Ahead of that, the setup, small cap 600 up 1.8%. Russell 2000 up 1.3. Bitcoin, by the way, down about 1,400%. The market, we're not seeing a big move in bonds.
Did you say 1,400%?
At 4.02%. Steve Grasso, where was it before the Fed decision? 4.02%.
Yep.
So the move in the last couple of weeks, again, the market is not waiting around. The bond market is actually going to run the show. Richard Clarida, PIMCO, really appreciate your time. Richard, thank you very much.
All right, so we're getting into the conference time now. This is where it gets meaningful.
Yeah,
this is what we're here for.
You hit it on the head before. If you're looking to May 2026, where Jerome Powell leaves his post, there's going to be a lot of doves that are released between now and then. The market's going higher.
I think, yeah, a wise man once said,
I should
this
have
is
had
what it
Prince
sounds like when
doves cry.
Fly.
He got it.
Right? Because
he got
I
it.
think the doves are going to be crying anytime soon. Richard Clarida, thank you. Steve Grasso, we'll see you tonight on Fast Money, 5 p.m. And as we know,
all right, here we go. Here's our boy,
Jerome Powell.
Come on, JP. Let's go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of this slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
Wow.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, great. And then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market.
Q&A section, let's go.
Do you see that as a possible outcome here?
Sorry,
tariffs
small bladder.
The reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
Politically charged question. I love it.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually
it's
the
certainly
increase
possible.
in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down.
Yeah, I don't know that I agree with that.
If any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. To the point where we see...
I think immigration is one of those things that's going to be seen more in the market over time.
Balance, that sounds good, but in this case, the balance
that seems a little presumptive.
Both supply and demand.
I mean, it hasn't hit the data. I mean, you're talking about a 6-month lagging
coming down
indicator.
A little more sharply because we now see the unemployment rate edging up.
Wow, that's an interesting choice.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
It's a dumbass question.
I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that.
It's still restrictive
over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June,
revised
July,
job creation
August,
numbers.
You can I can no longer say that. So
okay,
what that means is that the risk.
I'm going to cut him off a little bit here. That's frustrating as shit. He's saying that the jobs market was strong, but when you go back and look at the revised market, the revised data, then I can no longer support it, which means the job market was not strong. You just contradicted yourself in the statement.
Between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market and saying, well,
that was there the entire time.
Maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place?
Yes.
I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
I think you could think of this in a way as a risk management cut because if you look at the SEP, actually...
are we just going to ignore that jobs were revised down by millions?
Actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
You've think a million jobs just vanished.
150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
And see, now in response to this, you're seeing the treasuries lift up a little bit.
Once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2%.
Yeah, that's right. Stumble on that. Choke on that.
Sustained basis.
Choke on that, brother.
At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think.
Ooh, that one got him. That
and
question
in terms
got
of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Yeah, because a million jobs just vanished. I mean, am I talking to myself here? I kind of am talking to myself, but you know what I mean.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address.
Exactly.
How do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
Like a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later, and this year. This SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say
Shots fired!
2% inflation in 2028 at the end of 28, but that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame.
Doesn't matter what he says there. So yeah, he's absolutely right. That guy was spot on. Shout out to Bloomberg for hiring that guy. He's said this a lot. He's going to be out in next year, middle of the year. So he's basically saying you're kicking the can down the road. You get the same timeline. 2% is never going to be attainable. Frankly, it wasn't the rate up until recently, and until they tripled down on that. The unemployment rate has actually been dropped down for a healthy unemployment. So a really strange set of circumstances. And thank God for that guy calling it out.
The latest inflation report shows that prices are still going up across key categories for many households, including groceries.
Yep.
What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say.
But you haven't really done anything to stop it.
We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there.
Or you could argue it's still forthcoming. We haven't seen it yet.
Is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once.
That's fair.
What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, we have been.
Completely fair statement on his part. What I would say, though, is if the job numbers were just revised down by 1 million jobs, which meaningfully changed your perspective, by his own words, it was the impetus for him to now begin cutting in this cycle today. And by that suggestion, it is the most important thing. I would say you need to really look hard at the data.
To land a job.
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into,
I think it will,
into higher unemployment.
I think it will.
In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last.
I also think some of those jobs are ghost jobs, not real.
It's one of the reasons why we think
and
it's appropriate
scam jobs, people trying to scam you into something.
Policy focus toward a more balanced one.
Okay, it's fair.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point?
You guys see what I mean by diving into the nuances of the language here and spending way too much time analyzing? This is why the Fed shouldn't be so communicative, because now we're hanging on every word.
Looking at the data. You know what, let me say a word about the SEP really here.
Please do, Chief.
So we often point this out. What the SEP is it's an accumulation, of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks.
Then why did you put in the statement to Steve's point?
At the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods.
That's what it is.
Rather than this one is certain and this one isn't happening. So that's what I would say.
That was a total non-answer.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
Dispersion is weighted by the new Fed member, which the president put in place.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on.
And he's not wrong. It is a very unprecedented and strange scenario where your two primary objectives are moving opposite of one another, and there's really no easy unilateral way to fix it. So I'm critical, but he has a tough job.
It's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years. But as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political concerns?
How do we know you ain't corrupt, bro?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just
never consider anything else.
Really feels strongly about that way. So
okay,
you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things. at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now.
That's a fair answer.
People they're making their arguments, and we're having a great discussion around these challenging issues. So,
okay.
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman.
We do not comment on ongoing litigation.
So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW,
correct, wrong, noisy.
The revision that we saw was almost exactly what we expected.
Get the fuck out. Is he high?
So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey.
We're coming back to
this.
You've
got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work.
You just said it wasn't, dude. Just said it wasn't.
We have issues around data right now. It's about that's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes.
It's not a complicated problem.
Is
the woman just lost her job because of that at the BLS.
The response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly
Then why did you make decisions based on data you knew was not reliable? And why didn't you start cutting earlier if it was predicted?
Benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows
51%
job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates?
But he just said he knew it
earlier.
We have to live life looking through the windshield rather than the rearview mirror, as you know. And
what?
All I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
You just said you knew where you were then. That's like saying, "Hey, you caught me cheating," but we need to look in the windshield, not the rearview mirror.
So,
what?
As you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%. Declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Yeah, good question.
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's
people who really need jobs,
in addition to just overall lower payroll job creation. That shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut. But the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy?
That's what we talked about at the top of the show. 10% is carrying a lot of the consumer spending.
That. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment.
Mag 7 leading the S&P 500.
I don't know how long that will go on. No one does. In terms of spending, you saw the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers.
No, it is skewed, not may well. It is skewed. We have data on that.
It's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better.
But if it's only the wealthy who's growing the economy, is that a healthy economy? And the answer is no.
Unemployment is low.
Wealth gap's wider.
But downside risks. But it's still a low unemployment rate. So.
But you just said that data is unreliable, and you knew that. 51% of the jobs evaporated overnight.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around.
So basically, Scott Bessent has said that there's more form over substance, and they're not moving quickly enough because they're putting too much focus on the corporate governance, if you will, as opposed to the actually doing their job.
Through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to always trying to do better.
He's not affirmatively saying yes, obviously.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand.
Yes.
Higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so
that's fair.
Particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
But I think that's naive. You have to worry about AI's rollout. Every model has gotten so much better. The next model that comes out could wipe out a ton of jobs.
What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category. Yeah. And last year, goods inflation was negative. If you go back,
I think you're going to see tariffs show up more in the economy than you currently see it now. I think it's also a lagging delayed indicator. So to his answering this question, I would say it's almost like the jobs answer, which was wild, by the way, that you can't rely on the data you're currently seeing. And as a result of that, I think it remains to be seen with unprecedented tariff policy how unprecedented results might manifest.
0.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, you know, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than
we'll talk about that
we thought.
in a little bit.
But the evidence is very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
You gonna leave?
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants, of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And
wow,
I think that is the way the institution. That's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is?
I had not heard that
what's
poll.
Your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals.
We got to find that Gallup poll for tonight's show,
and we're not going to get distracted by anything. So, I think that's what we're going to do. We're just going to keep doing our jobs.
Doesn't answer, non-answer. Wow.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market.
No, it hasn't. You actually said earlier that it wasn't changed, that you knew it, so that makes you a liar.
The labor market was in solid condition, and we could point to 150,000 jobs per month and many other things.
Wow.
I think
tripling down that
new
shit.
Data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality. And
on the tariff thing that he said earlier, which it's wild to me, The problem is that as these companies who allegedly, and I don't believe this because Rosie's point, you've seen the pass through of some of the tariff costs to the consumer, as these companies start to show on their quarterly earnings statements and their financial reportings to the market, the publicly traded ones, and even the ones that are private that have boards, they're going to say, hey, we're not going to eat the profits because of the tariffs. We're going to pass those on to the consumer. So large companies don't just go, oh, okay, tariff costs went up, we're passing it on to the consumer right now, immediately day one. Small companies, small caps do that. But large companies with boards and policy and procedure and governance and probably regulation, they have to get to the point where they get their quarterly financial statements in, they look at those financial statements, and then they make decisions on pricing of their underlying products, especially if it's a B2C model. So you're going to wind up seeing those things still come through, trailing quarters after the tariff increases have been absorbed by those companies and then reported internally and then to the public. So to just write that off as, oh, we haven't seen it meaningfully yet, is just as naive as saying, hey, we knew the job numbers weren't accurate, but we relied on them anyway, even though we knew there was going to be a big revision. Oops.
There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do.
Listen, Hermione,
we came together
aren't you from London? Why are you asking us about our economy?
Acted with a high degree of unity.
Thank you, Archie.
Wow,
The
Corey.
Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the
Let's check the treasuries while he's doing that.
4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great.
The treasuries are largely unchanged. Nothing meaningful so far.
I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in. And it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment.
10 years up, 4.07.
We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change.
10-year
much. It's really
407
the risks that we're seeing to the labor market that
let's go one day here. Take a look.
Today's
so we saw the Treasury spike up. So the markets are not reacting well to his commentary.
Question. Given the cumulative impact of high interest rates on the housing
not
sector,
a huge move.
I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Great question. Great question.
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll
What
of
about
course,
home
raise
prices?
demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates for them to matter a lot for the
prices,
housing sector.
affordability,
And
bro.
the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing.
Tell that to the
And then
metrics and
last
the
thing I'll
housing
say
numbers.
is,
That's not true.
There's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for
Tell
people.
that to the South.
And all of the
Who's
areas
in a housing
around
recession?
metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
Translated loosely, he doesn't know
And
how to
just a
solve
quick
the
follow-up.
problem.
During
He has
the
no idea.
last SEP, or the
Not
press
his problem.
conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Good question.
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving?
That question
and how
pissed
do
him
you
off.
think about this
Look at
part of
his
the
face.
mandate when policy
That's
choices
angry
like
face.
rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time.
Basically saying
because
Trump's
we
pick
think moderate
spoke
long-term
out of
interest
line.
rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is.
It's borderline political commentary.
There's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Okay. Wow.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession.
Insignificant.
Delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. they're not at a level, I don't believe they're at a level or
Nothing meaningful there, but what I will say is liquidity in the system falling as a result of quantitative tightening, interest rates staying higher. So the question about why are they selling off the balance sheet while cutting rates? Well, if you're cutting rates, but you're also quantitatively tightening the balance sheet for the Fed by shrinking it, what you're doing is your interest rates stay higher, your financial condition tightens, inflation policy and goals are kind of counter-aligned, which is why he tried to downplay what he was doing with the balance sheet, saying that it was relatively meaningless in the macroeconomy perspective, because what he's trying to say is that behavior of trying to shrink the balance sheet for the Fed is not going to pivot the rate cutting cycle that we're in right now and the powers behind that.
Our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said,
this is the last question. We'll do a roundup real quick. I'll answer some chat questions and we'll call it a wrap.
Inflation. So if inflation goes up,
interesting.
Inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. I don't. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
That's it, kids.
Thanks very much.
There you go, guys. Gonna wrap that one up. All right, so we saw, largely recapping the market today, nothing meaningful in movements of the market. The treasuries and the Fed, everybody seemed to fall in line and expected it. I don't see any meaningful change in anything that we talked about and thought about today. So I'm gonna go ahead and cut to the main screen here. So there are some questions in the chat that I want to respond to before we move on. So Corey, typical time frame from CAF to when they are able to sell, 14 to 16 months. So Corey noted that he owns a cash crop and cattle farm. About a year and a half ago, calf prices were $400 to $600 a piece. We just purchased some last week for $1,400 a piece. That's crazy. I asked him the question, is the consumer seeing that? He said typical time frame from calf to when they are able to sell is 14 to 16 months. So I believe consumers will see final beef prices go up even more. This is just this summer when they were $1,000 a piece. And again, one of the things I'll continue to say is that you have not truly seen the impacts of tariffs passed on. That's going to go through that cycle we talked about earlier. Recusor, sorry, I don't even know how to say that. S&P 500 seems to have expected this, has not moved much. That is correct. It has not moved much. I think that we largely got what we thought we were going to get today, although I don't think the Treasury market liked a lot of Jerome Powell's commentary on some level. But again, the Treasury's going up after the last rate cut was a normalized action, so we're really just seeing what we saw last time here. So I do expect mortgage rates to rise up incrementally over the coming weeks. I've heard that more people talking about the rent and invest, the difference rather than buying a home. Can the mindset shift in the next generation create a drop in demand that will bring home prices down? Sure, if people can't afford to buy, I use this with demand without affordability is not demand argument all the time. Everybody can walk by and see a Lamborghini, but those who can actually buy it are meaningfully different. And if a home is priced like a Lamborghini is and we can't all afford them, then you're just window shopping at that point in time. And then at some point in time, there is the behavioral economics component. People will give up and they won't want to buy because they don't feel that they can do that. And you're seeing a lot of that narrative with the social media perspective of the rent and invest commentary now. A lot of that vagabond lifestyle came up from people giving up on the ideology of buying a home on some level as well. So it remains to be seen. We are truly in unprecedented times. And I do think that the AI revolution will catch up quickly and move very, very, very fast. So I don't know that it not taking away massive jobs now is indicative of that it won't take away massive jobs later. Best advice realtors can be giving to buyers and sellers at this time. Yeah, be honest, be authentic, be genuine. I think that a lot of times realtors want to sound like they know everything. You know your submarket, great. You know a lot of other things about the real estate economy, fantastic. But do any of us truly know where the economy's headed? No. And what I tell most realtors is that you don't have to tell people that buying their home is the best investment they ever made. Buying a home should not be for an investment. Everybody wants to think about the equity they're going to make over time because they know that net worth comes from that, and nobody wants a bad investment. That being said, you're buying your home for your utility. If you need the home and you can afford the home, it's always a good time to buy. That's the best advice you can give to them. And whether it goes up or down is irrelevant. It's almost like unrealized losses on banks' balance sheets. Those losses on banks' balance sheets are meaningless unless they actually have to sell. So if they don't have to sell, those losses are irrelevant to you and everybody else. It's like having your 401k. Looking at the price go up and down over time when you're in your 40s is irrelevant to you because you're never going to tap into that until you're in your 60s. So therein lies kind of the bigger problem in the thought process. That's the way you need to pitch your clients on it. And there's lots of healthy things you can come from that. And if you're that transparent, honest with them, they will appreciate it. They'll see you as a subject matter expert. And more importantly, they'll trust you and see you as authentic. Thank you so much, everybody, for tuning in. This was a very, very long one and our first live. I hope it's what you thought it was. Please comment or send us emails with things and suggestions that you think could be done better next time. And if you want to see more of this content or you think there's any other events you'd like us to cover, please let us know. Thank you so much. And if you have not subscribed by this point, I would be stunned. But tell your friends. We need all the growth we can get. Take care, everyone. Thanks again for tuning in. Bye-bye now.